Welcome to an in-depth exploration of hedge funds, a segment of the investment world often perceived as both sophisticated and, at times, opaque. These private investment vehicles operate distinctly from traditional mutual funds, offering a unique approach to capital management. Hedge funds primarily attract high-net-worth individuals, family offices, and institutional investors such as pension funds and endowments. Their structure and operational flexibility cater to those seeking specialized investment opportunities and potentially uncorrelated returns. Understanding their intricacies is crucial for any serious investor. Hedge funds are fundamentally characterized by their highly flexible investment strategies. Unlike conventional funds bound by strict mandates, hedge funds possess greater freedom in their asset allocation and trading methodologies. This adaptability allows them to navigate diverse market conditions. The primary objective of most hedge funds is to generate absolute returns. This means they aim to deliver positive returns regardless of whether the broader market is rising or falling. Their success is measured by their ability to profit in various economic environments. A key differentiator is their less regulated status compared to traditional mutual funds. This reduced regulatory oversight grants them the latitude to employ a wider range of investment strategies. It also permits the use of more complex financial instruments and techniques. This flexibility extends to the use of leverage, allowing funds to amplify potential returns. By borrowing capital, hedge funds can increase their exposure to certain assets or strategies. However, this also inherently magnifies potential losses. The potential outcomes of hedge fund investments are twofold. On one hand, they offer the prospect of higher returns, especially for skilled managers. On the other hand, this pursuit of enhanced returns often comes with increased risk, a factor investors must carefully consider. Hedge funds employ a vast array of strategies, each designed to capitalize on specific market inefficiencies or trends. Understanding these diverse approaches is key to appreciating their operational complexity and potential. One of the most common strategies is long-short equity. This involves simultaneously buying stocks believed to be undervalued, known as long positions, and selling short stocks deemed overvalued. The goal is to profit from the price differentials between these securities. Macro strategies focus on predicting broad economic trends and their impact on global markets. Managers in this category make investments based on their outlook for interest rates, currency movements, commodity prices, and geopolitical events. They often take large directional bets across various asset classes. Event-driven strategies capitalize on specific corporate events that are expected to impact a company's stock price. This includes situations like mergers and acquisitions, bankruptcies, spin-offs, or other significant corporate restructurings. The strategy seeks to profit from the anticipated price adjustments surrounding these events. Relative value strategies exploit pricing discrepancies between related securities. Managers identify situations where two or more assets, such as bonds, derivatives, or equities, are mispriced relative to each other. They then take offsetting positions to profit when these prices converge. Managed futures strategies employ quantitative models to trade futures contracts across various asset classes. These include commodities, currencies, interest rates, and stock indices. The models often identify and follow trends, taking long or short positions based on market momentum. Each of these strategies requires specialized expertise and a deep understanding of market dynamics. The choice of strategy often defines a fund's risk profile and return potential. Investors must align their objectives with the fund's chosen approach. The performance of hedge funds is a subject of ongoing debate and scrutiny within the financial industry. While they aim to outperform traditional benchmarks, their actual results are highly variable. This variability stems from several factors. Performance is heavily dependent on the individual manager's skill and investment acumen. A manager's ability to identify opportunities and manage risk is paramount. Market conditions also play a significant role, as certain strategies thrive in specific economic environments. The specific strategy employed by a fund directly influences its performance trajectory. Some strategies are designed for consistent, lower volatility returns, while others aim for higher, albeit more volatile, gains. Historical data suggests a potential for higher returns from hedge funds, particularly during periods of market volatility. During turbulent times, hedge funds, with their flexible mandates, can sometimes navigate downturns more effectively than traditional long-only funds. Their ability to short markets or employ defensive strategies can provide a degree of downside protection. However, this potential comes with a significant caveat: high fees. Hedge funds typically operate under a 2-and-20 fee structure, though variations exist. This means investors pay an annual management fee of 2% of assets under management. This fee covers operational costs and manager salaries regardless of performance. In addition to the management fee, funds also charge a performance fee, typically 20% of any profits generated. This incentivizes managers to achieve strong returns. However, these substantial fees can significantly impact an investor's overall net returns, especially if the fund's performance is lackluster. It is crucial for investors to understand how these fees erode potential gains over time. Even a high-performing fund might deliver less impressive net returns after fees are deducted. Transparency regarding fee structures and their impact is essential for informed decision-making. Assessing the true performance of hedge funds presents several unique challenges for investors. The very nature of the industry can obscure a clear picture of returns and risks. One significant issue is survivorship bias. When analyzing historical hedge fund data, only funds that have successfully survived and continued operating are typically included. Funds that failed or closed down are often excluded from these databases. This exclusion skews the results upwards, making the average performance appear better than it truly was for all funds launched. It creates an illusion of higher success rates and returns than what the broader universe of hedge funds actually achieved. Another challenge is the inherent lack of transparency within the hedge fund industry. Unlike publicly traded mutual funds, hedge funds are not required to disclose their holdings or strategies in detail. This makes it difficult for investors to fully understand the underlying investments. This opacity also complicates the assessment of a fund's true risk profile. Without clear insight into positions and leverage, investors may underestimate potential vulnerabilities. Due diligence becomes even more critical in such an environment. Furthermore, many hedge fund investments can be illiquid. This means that capital may be locked up for extended periods with limited opportunities for withdrawal. Investments in private equity, real estate, or complex derivatives can be difficult to sell quickly. This illiquidity can be problematic during market downturns or times of personal need. Investors might find themselves unable to access their capital when they need it most. Understanding redemption terms and lockup periods is therefore paramount. Hedge funds offer a compelling proposition for sophisticated investors seeking diversification and potentially attractive returns. Their ability to employ sophisticated strategies and leverage skilled management can lead to unique investment outcomes. However, the complexities and potential risks associated with hedge funds necessitate careful due diligence. Investors must move beyond headline returns and delve into the specifics of each fund's operations. A thorough understanding of a specific fund's strategy and risk profile is absolutely essential. This includes scrutinizing the manager's track record, understanding the fee structure, and assessing the liquidity terms. Investors must weigh the potential benefits of uncorrelated returns and enhanced performance against the associated costs and inherent complexities. Ultimately, hedge funds are not a one-size-fits-all solution. They represent a specialized tool within a diversified investment portfolio, suitable for those who possess the knowledge, capital, and risk tolerance to engage with this dynamic segment of the financial markets.